Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Dividend stocks have gotten really attractive to investors now because rising interest rates for the risk-free rate, which is the treasury rate, means that a lot of dividend stocks have actually fallen in price, increasing their dividend yield. So investors can find dividend yields of 5, 6, 7% from really solid companies right now. And there are 5 stocks that I think are really attractive both for their dividend yield and for the value of the underlying business. So that's what I'm going to get into today. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. And the first stock I'm going to start with is NextEra Energy Partners. If you're not familiar with this company, they're one of the largest renewable energy asset owners in the world. So they own wind and solar farms that have contracts to sell electricity to utilities, often for 10, 20, even 30 years. So they're going to own those assets over a long period of time, collect those cash flows, and then a portion of that cash flow goes to pay down any debt financing, and then a portion of it goes to a dividend. Over the last year, what the company has run into is higher interest rate means that a larger percentage of their future cash flows are going to have to go to refinancing or paying down debt. When interest rates go from 2% to 5%, that makes it much more costly to finance these projects with debt. And that's really what investors have become concerned about. But these are assets that still are extremely valuable. So it isn't like NextEra Energy Partners is going to stop having revenue coming in the door. It's just a matter of where's that revenue going to flow. Management said that what they're going to do is pull back on their growth expectations. Instead of growing at 12 to 15%, which would require buying more and more projects, they're going to grow at more like 6%. That's what they're targeting for their dividend growth over the next couple of years. The market has actually said that they don't even believe they can grow that quickly. So that's why the dividend yield right now is in the 13 to 14% range based on what management is expecting to pay out this year and even into next year. I think that is ultimately a great value, even if the company has to reduce its dividend. So in a scenario where it cuts its dividend 50% to try to pay down debt and reduce that leverage, reduce the money that's going into interest payments, that would still be a high yield dividend stock of 6.5%, 7%. I think there is a lot of value there for NextEra Energy Partners. They have long-term contracts. The concern about refinancing some of that debt at higher interest rates is something we need to be aware of. But there is excess cash flow coming from the business, and I think management can get around that and still be a high yield dividend stock long term. The second company is Vici Properties. This is one of the biggest gambling asset owners in the US. They own a large chunk of the Las Vegas Strip, and then they also own regional casinos. But they're a REIT, so they're going to own just the real estate. They don't actually own the gambling operations. That is done by other companies. But this is ultimately what makes this business really attractive to me. A REIT like this, you wanted to think about 2 things. What is their debt situation? And then can their tenants pay the bills? So what we're seeing in some of the office space buildings is, well, office tenants aren't paying their bills. They're getting out of leases. So maybe office space isn't all that attractive. Guess what? Gambling companies are going to stay in the casinos that they're in. They have 20, 30-year contracts to stay there. And the debt situation for Vici is actually pretty attractive. So with a dividend yield of nearly 6%, I think this is a great buy. And I'm going to show you exactly what the debt situation looks like right now. This is Vici's principal payments due from their debt obligations over the next few years. You can see that there is a total of $17.1 billion worth of debt. $1 billion of that is coming due next year, $2 billion the following year, and then in that $1.5 to $2 billion range until 2029. So while there's a lot of debt on the balance sheet, a lot of it is actually fairly long duration. We can go to some of the maturity of these notes here. I'll start at the top of this with their revolving credit facility that matures in 2026, but there is not much outstanding there. Some of their debt is due in 2032. You can see that there's a couple due in 2025. So maybe these 4.5% interest rates are going to increase when this needs to be refinanced. But we're still looking years down the road. So I think at the end of the day, this is a very manageable debt situation. And Vici Properties didn't have artificially low interest rates. So rates may go from 5.5% to 7.5%, but I don't think we're going to see a massive change in the amount of money that they're going to have to spend on their financing, which means that there's going to be plenty of money to pay investors that dividend. So, with a manageable debt situation and customers that I think are going to continue paying their bills, I think this is a really attractive business. One of the things that I always look at with a company like this is how much is the underlying business of your counterparties. So, in this case, of gambling companies growing. And the rents that they're having to pay are going to grow 2 to 3% a year, depending on how well the underlying business goes. But there are caps on how much that is going to increase. So, let's say that it's like 3% growth rate each year. The Las Vegas Strip in particular is actually having record revenue. So, they're vastly outgrowing the growth in their rent payments. This is one of the reasons that I like gambling stocks right now, but it's also a great reason to own a company like Vici Properties. The third company to look at is Verizon. Verizon, obviously the telecommunications company in the US, dividend yield of 7.4% as I'm recording. And the company has really turned a corner to increasing that free cash flow after a number of years of investment. They spent tens of billions of dollars on spectrum a few years ago, then have spent tens of billions more building out their 5G network. We're now at the point where they're harvesting the cash flow from all of that investment. So the big growth trend right now is their business segment and also fixed wireless. This is 5G wireless broadband that people can access at home or through businesses. They're adding a few 100,000 customers to that business every quarter. And that's fundamentally where the company is getting growth in its services revenue. That's the high margin piece of the business. We don't actually want Verizon selling a lot of hardware because they usually do that as a loss. We want them growing services revenue, and that's growing because of that business and fixed wireless segment. And what's really impressive for Verizon is that free cash flow has been improving the last 3 quarters. And we're now at the point where Verizon is starting to pay down debt. That has been one of the challenges for Verizon is they have a very large debt load. And like these other companies I'm talking about, when that debt matures, they're going to have to refinance at a much higher rate. So that's a risk for them. But if they're paying down $2, $3, $4 billion per quarter, they can pay down that debt at a pretty rapid rate. So the debt is a manageable situation. As you can see with this chart, their payout ratio is hovering around 50%. So that means it is a pretty sustainable payout ratio. And I think with those cash flows improving, this is going to be a business that's just going to get stronger and continue to be a great dividend stock. And with that yield at over 7%, it's very attractive for dividend investors right now. The fourth stock is Target. This company has been through a lot over the last couple of years, had inventory challenges last year, has been dealing with a significant amount of theft, something that management is really working on reducing over the next few quarters. But dividend yield of 3.4%, their recently announced quarterly results showed that their profitability is actually doing really well. Same store sales were down a little bit. So we're starting to see some softness from consumers, but their costs are under control. And I think at the end of the day, that is the positive thing for Target. You just want them churning cash out of each of those stores. And that's exactly what is going on. Those margins are starting to improve. They're moving to more of what they call their owned brands. So brands that they're going to be able to basically white label other people's products, a little bit higher margin than when you're buying a brand name product. And you continue to grow that grocery segment and drive up segments. So it becomes a very sticky product that people are using week after week. I think that's ultimately put Target in a very good position, especially against its e-commerce competitors who were really the threat a few years ago. They've really found their place in the brick and mortar retail segment. This isn't going to be a high growth company. The growth that we saw during 2020, 2021, during the pandemic, Target has actually done a very good job of keeping a lot of those customers and keeping a lot of that growth in revenue, but just slowly and steadily growing from here, I think is what we should expect for investors. Keep that 3.4% dividend yield coming. And I think in the retail space, this is one of the best stocks out there right now. Also happens to be a great value at about 16 times trailing earnings. A lot to like from Target stock. And the final stock is consumer goods company Nike. 1.3% dividend yield. The price to earnings multiple is a little over 30. The stock has actually not gone anywhere over the past year, but I think this is one of the steadiest companies in the fashion business over the last few decades, really. They have a great direct to consumer business. They have their own storefronts, and then they also sell through a lot of retailers as well. So very powerful position, very powerful brand. Like I talked about with Target, this isn't going to be a company that's going to really impress investors with a ton of growth. But the point is just to churn out money from the existing business and continue that brand strength. So 1.3% dividend yield, not the biggest dividend yield in the world, but if you're looking for a solid company that's going to be likely around and very relevant 10, 20, 30 years from now, I think Nike is going to be one of those companies. They've just got the kind of brand that consumers are going to keep going back to. So love their position and their stock right now, despite the fact that it's a relatively low dividend yield compared to the other stocks that I talked about. So the stocks I covered today: NextEra Energy Partners, ticker NEP; Vici Properties, ticker VICI; Verizon, ticker VZ; Target, ticker TGT; and Nike, ticker NKE. What do you think about those 5 dividend stocks? Leave those comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.